I'd like to thank everybody for joining me today. Today, as we're kicking off the new year, it's a great time to help our clients with their tax planning. And as we're helping our clients plan, we can come up with a lot of great ideas. But if they don't have the money to be able to implement those ideas, it just isn't going to help them. So part of this is, as we go through the tax planning, can we help our clients find lost money, money that they're paying to Uncle Sam that can be saved and repositioned in other places. As we look at tax planning, it's always good to understand what the taxes are and remind ourselves. We have payroll tax, income tax, we have capital gains tax. All of these taxes really affect our clients on a daily basis. And if they're running their business, they understand that these taxes are eroding a lot of their income. And a lot of times with our clients, this is their biggest creditor. They plan for other things, but can they reduce their taxes? As I look at this, as we're helping our clients, and as we start that engagement with our clients, the key is gathering data. We talk about gathering data about our clients, their goals, their objectives, and about their family, about their business. And we should take the time to understand that. I also think it's a great time to really dig in and understand our clients' financial statement, understand their income statement, understand their taxes. Because the more we see, the more we can help them. We can help them see how they can make one change that's going to benefit them from both a tax, planning standpoint, which everybody loves to save taxes, but it also frees up that money to do other things. As I look at this, start going through, and I've got it my tax background, so this is something that I've worked on over the years. But it's looking at the different tax returns. As you're into a tax return, you can see what a client's doing. And when I work with a client, I always want to get at least 2 years of tax returns, the most recent tax returns, business and personal, so I can start understanding what's happening. If I looked at this and see a 1065 return, that's a partnership tax return, I know they probably have a self-employment tax problem. So a lot of times we see just a Schedule C, and of course that's taxable. But if they're a partner in a partnership, or they're a member of an LLC being taxed as a partnership, well, they're now paying a self-employment tax. Can we avoid that self-employment tax or reduce it? That's what we want to start looking at. And that's why taking the time to read the tax returns are going to help you. As we look at this business return, now you can start going down through that and start seeing the individual things that are happening. So if I look at a tax return, a business tax return, now this can be a partnership return. It could be an 1120 or an 1120S, which are our S corporations and C corporations. If I come down and see depreciation, well, if I look at the depreciation and see a large number on the depreciation line, that gets my mind thinking, can we accelerate that depreciation with a cost segregation? And cost segregation, what that allows a client to do is basically speed up the depreciation that they're allowed to take, so it matches more with their cash flow. If you think about a client, they go build a building today, and they might be out $1 million, $2 million, $3 million, whatever it is to build that building. Well, the IRS in the tax code says, well, if that's a rental property or is being treated as a rental, okay, you're not going to be able to depreciate that maybe for 39 years. But if we can go in with the cost segregation, we can accelerate a lot of that depreciation that would be spread over lots of years and take it on today's tax return. And I look at it from a client, the cash flow's already been spent. Now can we match up those tax deductions so we get their money back working for them faster? As I'm also looking at this, with the cost segregation, you get to see, this from both a personal standpoint, if they've got rentals, you get to see it from a business standpoint. Now, let me give you a caution on the personal tax return here. if this is a rentals are a passive activity. And so you've got to be careful. Yes, they may be able to accelerate their depreciation, but if they have passive income, being caught up in their tax return, because passive income can only be offset by passive expenses can only be offset by passive income. Well, we can generate more passive loss, but if we can't use that on the tax return, it's a waste of money. It's a waste of time to do this. So we have to, just because they've got depreciation doesn't mean we can accelerate it, but it's worth looking at. Then when I come back in and start looking at a business return and I see, that they have good, steady taxable income, that their total income is high. They need additional, deductions at the business level. And we could look at a captive insurance company. If they have risk, that is not being insured right now, then a captive insurance company could be a fit. What's nice about a captive insurance company is they get to treat this as a deduction to their operating company. And when that money's received in their captive insurance company covering their risks and associated risks of the pool, that allows them to now treat that not as deductible on the business return, not treated as income on the captive's return. So it's a good way to, create tax savings. It's a great way to now bring in the risk mitigation that they need as a business owner. As you go down that business return, now look at it. Do they have employees? Well, if they have employees, now we can start looking at, if your securities license, look at their retirement program. Can they improve their 401k? A lot of times I'll talk to clients that don't have a lot of employees. Maybe a defined benefit plan makes sense, or a profit sharing plan for, to add on to a 401k. Look and see, can they do more for their employees? As we're also looking here, this is a great time to look at, do we need some employee retention or key man type of policies to protect the company? So when you start thinking employee retention, think golden handcuffs for the key executives. Potentially, we can have R&D credits here because of the utilizing the employees. But there again, if we can protect that business and do it on tax deductible dollars, it's going to create a more efficient return. When I come over to the individual return, this is where it gets a little harder. And the harder thing for an individual is a lot of individuals, they're making a lot of money as a W-2 employee, but they're limited in what they can do for tax planning. So first thing is, are they maximizing their retirement planning through their employer? And there again, you can't pick and choose which retirement plan. It's whatever's offered by your employer, but it gives you the opportunity to look and see, can you do more? Are they maximizing that? On an individual return, and if the individual has no business, no rental property, none of that happening, the only other place you can do a significant amount of planning is the itemized deductions, specifically charitable planning. So we can create way better deductions, more easy deductions on a business return. An individual return, we're limited to retirement accounts and we're limited to charitable planning. So a lot of times we may have to work with that client to see, can they create a business so that we can do more tax planning? But as you go through working with your client and helping them become more efficient on their tax planning, this is a great time to, take the time, look at their planning goals and objectives, look at their financial statement, look at their tax returns, open your mind up to spotting the opportunities for that individual client, and then move forward helping them implement a plan that is good for them. So if you think about this is a great time of year. This is when people are talking taxes. It's that time of the season. So help them understand, if they're wanting to reduce their taxes, they can, but it takes planning and it takes work to do it. I appreciate everybody getting on. If you ever have any questions, feel free to reach out. And if not, we'll talk again next week. Thank you.